Most directors don't realise they could owe money to their own company until it's too late. And this is the most dangerous debt in your business. Now, in the UK, thousands of directors go through insolvency every year, having no idea they had something called an overdrawn director's loan account. And it's a debt that the director owes back to the company. Now, if you don't understand your director's loan account and how it works, you can end up personally liable for tens, even hundreds of thousands of pounds. And when the company goes under, that debt doesn't disappear with it. You become the target. You owe the money back. Now, I had a client who ran a recruitment firm, and he thought he'd been taking dividends from profits of the company, like most directors do. Now, I helped him understand his director's loan position, and he'd withdrawn £85,000 more than the company had earned. And he said, Chris, no one ever told me that this was a problem. I thought it was my money. And that's the trap. And that's what we're going to break down today. What's a director's loan account, how it works, and how to protect yourself before it's too late. So, what is a director's loan account? A director's loan account, or a DLA for short, is a record of all the money moving between you and your company. It's a running balance, like a ledger. Money you put into the company is recorded as the company owing you money. Money you take out that isn't salary or expenses is recorded as you owing the company money. Sounds really simple so far. So your director's loan can go one of two ways. In credit means the company owes you money, or overdrawn and you owe the company money. It's like a bank account between you and your business. Now, how directors accidentally create overdrawn director's loans, because this is the problem. And I think most directors don't do this intentionally. But the first thing is they're taking drawings, okay, that they believe are dividends instead of salary, okay? Now, many directors will withdraw money each month, and in their head, they think it's a dividend, okay? And they hope at the end of the year, the accountant will sign off the books and say that's no problem, okay? But if you've not made a profit, okay, or if you've made less profit than the money you've taken out, those drawings are basically illegal dividends, not illegal that you go into prison, but they're converted into a loan from the company to you. So a really, really simple explanation is this. Let's say you're on £1,000 a month salary, PAYE, and you take another £3,000 a month out of the business that you call a dividend, okay? Now, it's not a dividend yet. It's a drawing in hope that you've made enough profit at the end of the year that your accountant can declare a dividend. But let's say this last year, your business has been a bit slow. You've not been able to pay HMRC. Your costs have risen. There's a number of reasons why you've not made as much profit this year. But you've still continued to take that £3,000 a month that you class as a dividend. But at the end of the year, the accountant goes, you've not made enough money, or you've made no money. Basically, the £3,000 a month you've taken could be reclassified into an overdrawn director's loan account, and out of nowhere you owe the company £36,000, okay? Now, another way that you can increase that director's loan is if you use your business as a personal bank account. What I'm talking about is paid personal expenses from the business account. This could be personal cars, it could be home improvements, it could be holidays, it could be clothing. There's a rule like if when you're trying to put something through your business as a business expense, it has to be wholly for the benefit of the business. If there's any duality of purpose, the easiest one is like a really nice suit, okay? And you think, well, I only wear suits. I mean, I don't really wear suits. If I'm ever going to wear them, they're going to be funerals and weddings. But let's say I bought a really nice suit for business meetings. Well, HMRC's view is, well, there's duality of purpose, Chris, because you could use it for a funeral, you could use it for a wedding. Therefore, it's not a company costs, okay? So anything that you use the company for that's a personal expense will be added to your director's loan account. And sort of following on from that, using the company as a piggy bank. If you're pulling cash out the business, right, like cash out the wall, Or when you've had a good month and you think, oh God, we've made, I don't know, 15 grand this month, I'm going to take 15 grand out. It's not a balanced way of doing that, is it? It's logged, and that's another reason where you can become overdrawn. And sort of touching on what I said at the introduction, dividends without profits, okay? Now, you may still be taking dividends out of your business and doing a dividend voucher and declaring this as dividends. But if your company has been loss making in that period and an insolvency practitioner comes along and your business goes through insolvency, these dividends are going to be reclassified as loans and not income. These are the main points where you can all end up with massive overdrawn director's loan accounts. And I'm going to tell you why now a director's loan account is particularly dangerous. Well, the first thing, remember, I'm an insolvency guy. My name's Chris Worden, by the way, if you're not watching the channel. I'm from Director First. I offer free and independent insolvency advice to directors across the UK. And if anything I've said so far has worried you, I want you to go to the comment section below. There's a link at the top. Put your details in. One of my team will call you today for some free and independent advisory around directors' loans and what it could mean to you. Now, why overdrawn loan accounts are particularly dangerous? One of the scenarios is it's personal liability after an insolvency. If your company can't survive, it's not paying its debts on time, there's creditor pressure, you're building up HMRC arrears, there's a good chance that you could end up in insolvency. And once you go in insolvency, an insolvency practitioner is appointed, or they're sometimes called a liquidator. And the liquidator's job is to recover as much money as possible, okay, including anything you owe to the company. And an overdrawn director's loan account is one of the easiest wins. Let's say your director's loan account shows that you owe £50,000 to the business. They'll demand repayment personally. And if you can't pay, this is a scary thing, they can take legal action. They can apply for a charging order against your house. In some cases, people get made bankrupt over overdrawn loan accounts. And a lot of the time, you don't know that you've got one. And I'm going to come to it a little bit later to tell you how to find out where you've got an overdrawn loan account. Here's another problem. If you don't go in insolvency, HMRC are going to charge interest and S455 tax on your overdrawn loan account. If your DLA is overdrawn by more than 10,000 at year end and it's not been repaid within 9 months, your company has to pay something called S455 tax. And this is the rate. I hope you sat down. It's going to cost you 33.75%. And basically HMRC holds it until you repay the loan. So it goes on your corporation tax. Now, if your company fails before repayment, that tax is lost and they'll look to recover it from you personally. Now, there's another thing that's a problem. It's called the benefit in kind. And the benefit in kind rule basically says if your director's loan account exceeds 10,000 and you don't pay interest to the company, it's classed as a benefit in kind. And that means personal income tax for you and national insurance for the company. And HMRC can backdate these claims several years. So a director's loan account starts as an accounting entry, but it can end up as a personal nightmare. Okay? Now, I want to talk to you not about how you can fix a director's loan account, but perhaps how you can manage it, right? So the first thing is you've got to know if you've got one, right? Know what your director's loan account is today. Now, there's a number of ways to do this. For those that watch my content, you will understand how passionate I am about you understanding the finances in your business. Because if you understand your finances, you can make better decisions. Now, a lot of people out there do not understand finances. So get a bloody bookkeeper and get somebody to do your management accounts. They're so easy to do. I say they're so easy to do. Make sure you have a professional doing it. Apparently it's easy to plaster a wall. I would make a real mess of my wall, okay? But if you have a good bookkeeper and they use Xero, QuickBooks, Sage, Free Agent, something like that, you'll get a set of management accounts every month. And what you can also ask is a trial balance off that software. And as long as that software is up to date and you look through the trial balance, you will see in the asset section, or the debtors section, debtors means people that owe the company money, you'll see where a director's loan sits, or it might be called director's current account, or it might be called director's advances. And that will tell you whether you're in credit or you're overdrawn. Now, if you don't have management accounts, it's a little bit trickier, because you're probably sat there thinking, oh, well, I'll ask my accountant. Now, if your accountant just does compliance, and all that means is he might do your VAT returns, might do your payroll, might do your year end, okay? You're going back to your last set of accounts that could be 18 months out of date, and you're checking on Companies House or on your email what your director's loan account says on that set of accounts a couple of years ago. I'll tell you why that's a problem. Your year-end accounts are a snapshot of your business one day in the past. They are they're useless for managing your business day to day, okay? So if you're still doing that, and this is what we're going to have to do, you go back to those accounts and go, right, well, my overdrawn loan account was 50 grand at that point. Well, the reason why that's not much help to you is because there's a blooming good chance that you have you have taken more money out of that business that isn't on the payroll, okay? So you could basically look at your last set of accounts and go, okay, well, I was overdrawn, I was in credit since then, but then we're going to have to look at, well, what's happened since those last set of accounts? Remember, any money that you put in goes as a credit. But if you put that money in, then you've took that money out, it's going to go back as a debit again. And again, this is a real big problem, okay? And again, if you want some help on this particular point, that's what we specialise in. Help you understand your director's loan position quick. You go to the comment section, you click on the link, one of my team will call you, okay? So once you understand the balance, and you can do by doing like a transactional analysis, let's say your last set of accounts were 6 months ago, you was overdrawn £10,000, but since then you've become insolvent, you can't pay HMRC, you can't pay your creditors, well, you can't take a dividend since that point. Now, if you've continued to take £3 a month in your head that you remember you call a dividend, it's not. It's going to be classified on your director's loan account. So you don't just owe 10,000 that you were overdrawn 6 months ago. You actually owe 28,000. Okay. Again, it might sound confusing. I can help you understand this, but you know what? If you're just watching this for a bit of advisory, go and get a bookkeeper. Okay. Dead important. So step 2, if you can you repay something into the director's loan account? Now, if it's overdrawn and you can repay it before the company year end, that will reduce or actually get rid of the S455 tax, and it can improve your position. But I want to talk to you about this point, right? You only repay it into the bank account if you believe the business is going to it's going to be saved. If you believe that the business is over, right? Insolvency is a test. Can you pay your debts when they fall due? Okay. If you're on a time to pay arrangement with HMRC, technically you're insolvent. If you're robbing Peter to pay Paul every month, you're insolvent. Okay. Next test is balance sheet test. Are your liabilities more than your assets? If you fail both of those tests, you're insolvent. But here's the kicker. What you've got to ask yourself, and you've got to be truthful with yourself, is there any way I can recover from this business insolvency? Is there a chance that in a few months we're going to improve things and get back on a firm financial footing? And if there isn't, you've got to be careful. Stop what you're doing and pick up the phone to somebody like me, okay? Now, step 3, I want you to record everything properly, okay? Anything you take out of the business should be tagged either as salary or drawing or an expense, okay? If you're taking a loan out of the company, because some people can do that, right? It's got to have terms, even if it's informal. Have something on email. Now, step 4, please, if you're watching my videos, I think you're probably insolvent. Either that, or you've got a fetish for bald guys with big glasses, right? I don't believe like people watch my videos. Certainly, what's this been going on 15 minutes? If you're still watching this, you've got a problem, haven't you? Right? Please stop taking dividends out of your company, because if you're taking in your head a dividend but you're not paying your bills on time and you're insolvent, everything you're taking at the moment is going to get converted to a director's loan account, and an insolvency practitioner is going to chase you personally for it. You're making the problem worse, okay? Now, you can You are still entitled to a salary out of the business, okay? But you're better off being on the payroll. If you're not making money, stop taking dividends. Go and ask your accountant, can I be put on the payroll? Now, you can't be on ridiculous wages. It's got to sort of be in line or less than what you have been taking. And step 5, if you're insolvent, can't pay your debts when they fall due, and you don't think that you're going to recover, get advice early. Because if insolvency is likely, speak to somebody like me. Now remember, I'm not an insolvency practitioner. I work with licensed insolvency practitioners. That's all I work with. But my job and my team's job is to give you some director advisory, okay? And what we do is we go through all your options, but we also tell you what the problems are for you personally, which an insolvency practitioner can't do. Because most people don't understand this. An insolvency practitioner is there to advise the company. You are not the company, you're the director. So they can't advise you on personal guarantees. They're not really meant to advise you on directors' loan accounts, and most of them don't. Director first, that's what the name is. We have got an incredible reputation. We're doing this for years and years, and our advice is always to you to help you understand your position, and we do it quickly, okay? We do it quickly, so after a couple of phone calls, you understand what's going on. Because do you know, when you take advice early, the more options you've got available? Because I know a lot of you are watching there going, I really don't want to face up to the reality that maybe my business won't survive. I'm hoping, you know, I'm reading my inspirational books. I'm listening to my Tony Robbins in the morning. I'm writing my gratitude lists. Listen, I've been there. I really have. And when it comes to this, you've got to see things as they are, not worse than they are, and not better than they are. And taking advice, I promise you, most people that I speak to say, Chris, I have had the best night's sleep speaking to your team. Okay? So let's move on. Directors' loan accounts in insolvency. Okay? This is the big problem. Because when a company is insolvent, remember, can't pay its debts when they fall due, liabilities more than the assets. The director's loan is a debt that's owed to the company, and an insolvency practitioner is duty bound to recover it, okay? Now, this is a bit controversial in my world, but I'm going to say it. Some insolvency practitioners don't mention this, okay? They don't mention this. They don't mention this until you've appointed them. And you know what? They're doing right as based on what they're saying. Okay, they're not there to advise you as a director. Maybe it's a real urgent insolvency and they've just got to get you into liquidation or administration. But for me, you need to understand this up front. You can't put off going into insolvency because remember, once you're insolvent, your duties as a director is not to make the creditors' positions any worse. You cannot start taking more debt on with suppliers. You can't be racking up HMRC bills, right? You've got to take advice. But my belief is you need to understand this, because if you don't pay your director's loan account that's due, the insolvency practitioner can start legal action against you. You know, if you're in rented accommodation with not a pot to you know what in or a window to throw it out of, the reality is it will get written off or you'll be able to settle it very low. But if you're there with an equity in your property, say you've got buy-to-lets, you've got investments, you're really, really vulnerable. Now, most of the time, an offer of settlement is possible with an insolvency practitioner, right? But you've got to be transparent. Okay, if you try and hide directors' loans, if you think, oh, well, they've not mentioned it, I'm not going to mention it. Let me tell you, they're going to mention it, but they might mention it at a point where it's too late. Because once you've appointed an insolvency practitioner, there's no going back. This is what you should do. Speak to someone like me, okay? And what we'll do, we'll understand where your position is on your director's loan account. And then, in principle, there may be a deal done with an insolvency practitioner. Because an insolvency practitioner, their role is to is the duty bound for creditors. They've got to try and get the best outcome for creditors. Now, let's say you've got an overdrawn loan account of, I don't know, 100,000 quid. Do you know what? I'm actually going to pull one up that we've done recently. Here we go. So this chap had £1 million house, okay, with a £400,000 mortgage, okay? So obviously very, very vulnerable. And he had a 90 grand director's loan account that was overdrawn. And he was, Chris, I'm gonna be made bankrupt. I'm gonna lose my house. And I said, right, well, let's get into this. So basically, even though the house was worth £1 million, in an insolvency scenario, what they'll do is they'll value it at sort of 85% of what it's really valued at. Because in insolvency, if you don't pay a director's loan account, one of the options is bankruptcy. So they've got to weigh up, go, will I get more out of this director for creditors if I make them bankrupt? So that £1 million house is actually worth 850,000 in a forced sale scenario, okay? The mortgage was 390,000, which means there was 460 grand equity. And you're thinking, well, if he's got 460 grand equity, he's screwed. He's going to have to pay it all back. Well, half of it's his wife, and his wife has nothing to do with the business, okay? So when you factor in selling the house, remember it'll be a percent to sell your house. So £1 million house, it's 10 grand to an estate agent. Solicitors are 3 grand plus VAT. So available funds were 446. Well, his half of that is 223. And you're thinking, well, he's absolutely screwed, Chris. By the way, his director's loan account was 90 grand, okay? So then we've got to factor in, right, what is the cost of making a director bankrupt? Because guess what? It's costly, okay? I'm going to go through some of the costs. You've got an official receiver cost. That is going to be 6 grand plus VAT. You've got a petition to make someone bankrupt, 2 grand plus VAT. You've got something called a trustee in bankruptcy, which is basically an insolvency practitioner who's going to take 15% of the realizations, okay? So in this one, we've estimated about 40 grand. It could be a lot more. Let's put down their £25,000 in legal fees to chase this person. So we're looking at this particular job. It's going to cost him 75. It's going to cost the insolvency practitioner 75 grand to make him bankrupt. But guess what? Bankruptcy, although that's quite quick, forcing someone out of a house with kids could be years. And there's a lot of risk in that. Because during those 2 or 3 years where you're trying to get someone out of the house, this guy could hock up a load more debt and his personal position will be different in 2 or 3 years' time. He could sell up and bugger off to Dubai. I'm not giving anyone ideas. These are just considerations for an insolvency practitioner. So most insolvency practitioners don't want the risk. Now, you factor into this as well. This guy had £150,000 worth of personally guaranteed debt that was going to hit him as part of the insolvency. So guess what? He owed £90,000 and guess what he got it settled for? He got it settled for £30,000. So a huge discount. And that was a better realisation to creditors than actually making this guy bankrupt. So here's the bottom line. Director's loan account is a record of money between you and your company. If it's overdrawn, okay, if you're not profitable, if you're in debt, let me say that again. If it's overdrawn and the company's not profitable and you're still taking money out, there's a chance that your overdrawn loan account has gone up, okay? It's a debt to the company. And in insolvency, it's going to follow you personally, right? You've got to understand it, manage it if you've got time, and fix it before it fixes you. So listen, if you found this video useful, right, and you've enjoyed what I've got to say, go over here, okay? I'm going to give you another real life example of how directors' loan accounts get settled, what you've got to be worried about. It's going to help you understand. And if any of these situations fit yours, pick the phone up. Chris Worden, Director First. Thanks for your time.